Hi, Tim Kerin here from Mortgage Choice in Kingsley. Today I want to have a quick chat about interest rates, not because it's necessarily the most exciting topic in the world, but because it's an important one, and I want to take the opportunity to just clarify a few things relating to the questions I've been getting asked lately. So first I'll explain a little bit about what's going on and then explain the impact that's having on interest rates. So it's important to just conceptually separate products the way the government is now forcing lenders to, which is only new in the last 3 years. So on one hand we have owner-occupied residential lending, which is lending for the purpose of buying an owner-occupied house or anything that's not declared to be an investment purpose, buying a car, topping your loan up to go on a holiday, refinancing your owner-occupied home, anything like that. That's determined to be owner-occupied debt. And on the other hand, we have investment debt. That's money borrowed to buy an investment property, or for some other purpose. You might borrow money secured against your house to buy some shares, something like that. So there's the distinction between an owner-occupied purpose and an investment purpose. That's not new. That's the way it's always been. When we submit a loan application, we have to declare what the purpose is. What's different now is that the government is forcing lenders to determine their price based on which one of those two things it is, and I'll get into that a bit more. The other thing to be aware of, apart from the difference between owner-occupied and investment, is the difference between principal and interest only. And you can have any combination of those two things. So you could have, for example, an owner-occupied loan that's interest only, or an investment loan that's interest only, or you could have an investment loan that's principal and interest, or an investment loan that's interest only. So those four different options equal four different interest rates at the moment. And over the course of the last 2 or 3 years, lenders have been forced to reprogram their software to allow for this, and that's why they've been changing their policies one by one. The other thing that's causing that to happen is two rules the government's brought in. One was a little bit after the middle of 2015, where the government said if lenders have an owner-occupied portfolio of lending and an investment portfolio of lending, this investment portfolio cannot grow by any more than 10% per year. And that was enough for some lenders to pull out of the market completely for 6 months in one case. Then in March 2017, lenders said that the split between principal and interest-only lending has to be 70-30, or more to the point, the interest-only lending can't go any more than 30% of what they do. So we have those two restrictions now causing lenders to change their rates based on the purpose of what you want the money for and whether or not you want principal and interest. And so what we've seen is a lot of customers' interest rates going up because they decided to take interest only when it didn't make a difference to the rate, and now suddenly it is making a difference to the rate. So there could be an opportunity for you, if you're in that camp, to simply switch to principal and interest and be able to save some money. Likewise, people might have moved out of an owner-occupied property and had it become an investment property, and then they do another loan application for some reason, the bank figures out it's their investment property and puts their rate up on that existing debt. So there's all sorts of combinations and permutations of those sorts of situations that has caused rates to change. And within all that, lenders have been jostling for position. So if you're a lender, for example, that's typically doing 40% of their lending as interest only, and they want to cut that back, one way to do that is to pull this lever. If you do more principal and interest business, then you can do more interest only business. So you can see, even I'm getting confused with all the different wordings, even though I do this every day. It's complicated, and when I have a scenario nowadays, very different to 5 years ago, where someone wants the best rate. Now it's quite a complicated thing to figure out, but that's what I'm here for, and that's what I'm doing. So if this helps you realise that your rate needs work, get hold of me and see if I can figure out if there's a better deal. It might be surprising how we can make that happen, but usually there's an answer, particularly if there's a bit of equity in your property as well. I hope that helps, and look forward to talking to you soon.